Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, Phuong gets into cap table construction, how to think about how you allocate ownership of the company, particularly in the early days. This is an episode that every new founder should listen to, full stop. A lot of the content we do, podcasts will come and go and they won't be relevant for long periods of time. It might be tied to a current event or otherwise. This is probably evergreen content. So if you're listening to this 5 years from now, I think it's probably still going to hold unless the market materially changes. So strongly recommend you listen to this. Cap table management is one of the most important things you need to do when you set your company up to avoid having future problems, including scaring away investors. So you want to get this all sorted out in a very clean and culturally accepted way. And we kind of run down and through that a little bit in this session. Enjoy. All right, Phuong, ready for another sesh?
Oh, totally ready. I'm excited to talk about our topic today, Mark. So today I wanted to talk about one of the most critical, I think sometimes confusing and anxiety, causing topics for founders, and that's equity. It's how much equity do founders split up amongst themselves, how much they give to their early employees, relatedly, how do you set up a cap table that includes all those people and your investors and your advisors at this really early stage that will scale with you as you grow? And then lastly, just how you kind of maintain that motivation for you and your employees based on the ownership as your company grows and potentially gets diluted.
I want to help frame this before you jump in.
Yeah.
There is no right and wrong, but at the same time, there is a right way to do this. And the reason why those two things can be true is objectively, you could structure this a million ways and it could probably work. But VCs and investors are looking for norms, cultural norms that have been developed over decades that signal that the business will kind of balance out. And a lot of the issues we've seen through cycles will be preemptively resolved. And so that cultural norm has become the right way through lots of iterations. And when there's a real deviation from the cultural norm, it's kind of a red flag to investors. Even if it could work, we get nervous that, hey, there's a wire that could be tripped. So I think this is a really important topic. If you're trying to reinvent the wheel here and thinking, hey, I'm going to do this, and this, and it's going to work, you might be right, but you'll still be wrong. So worth listening to this particular segment.
Yeah, I think if we do anything that can help founders kind of avoid some of those red flags that's going to put off investors, that's going to be, that's the objective of this episode for me. So yeah, let's get started. The first, I think where I would normally start is thinking about the founders themselves, right? Like those are the people there, the only people that you're thinking about at the very beginning. And I know, Mark, you've worked with a lot of companies at this initial stage, and you've started a lot of companies at the stage with, by yourself, with one or two co-founders. Do you have any insight on how you think about equity splits amongst founders initially?
Yeah, the headlines and the parameters are at their core very simple. You want to make sure everyone has enough to be motivated. And you want to also make sure that you distribute enough to make sure you have a complete team. And so for people who listen to this pod frequently or just kind of diving in, go listen to Phuong's coverage of the Superman analysis, which helps you figure out what kind of your core team needs to be. But the right and the wrong in the balance, there's different scenarios, right? You have single founder companies where the founder starts with 100% and then gets diluted down. You've got founder teams with 4 people. all of those work. The key is that everyone has enough to be motivated, and they've shared enough to develop to have all the core skills on the cap table that they need to be successful. And it's that juggling act, that balancing act that people are looking for on the founder side.
Yeah, I think that's right. And I think like a framework to think about what that means, how that translates to actual numbers, is that thinking that each of these splits should really reflect each founder's level of commitment and the value that they bring to the table, right? Like if all the co-founders are contributing, an equal amount and have the equal level of expertise, then an equal split makes sense. But for example, there's sometimes a founder that's bringing more, like maybe they came up with the idea or they have a ton of experience or they invested some capital up front. Then maybe you're thinking, it could be weighed 60-40, 70-30, or, a little bit differently if there are more than two founders. And that's, I think, totally fine. It's really about, being fair. Like the person bringing the most value and commitment early on ends up to have a little bit more ownership. But I think to your point, like beyond what the numbers actually are, it's important to have this honest conversation with your co-founders at the very beginning about what you're bringing, what you're committing to, and how that translates to long-term commitment.
And I suspect you'll come back to this, but that I want to double click and emphasize that long-term phrase you just threw in there. Vesting is the thing that most founder groups don't set up when they set up their splits. And if you put vesting in from the very beginning, which we can talk about, obviously, you pre-handle those awkward moments later when someone decides they want to get a real job, or maybe you're 4 students or 3 students and everyone else is not going to drop out of school, but you are. You can solve all of those issues up front when it's not weird, when no one knows which side of the table they're going to be on in that negotiation, with a standardized framework for using vesting. So I'm sure we'll come back to that, but I wanted to flag, this is the outside of finding that balance. The other key thing everyone has to do at the founder side is put vesting structures in. Full stop.
Yeah. Yes. And let's definitely talk about that once we talk about kind of the split up between of the equity. But I think this is an important point you bring up too around, other people's commitments, whether in school, whether they're working. At this point in your company, you don't really have that much money, right? If you have any. And so the idea of sweat equity is an important concept to go over. And I'm sure everyone knows sweat equity is having ownership in exchange for time or effort with little or no salary. So, founders and early employees are often compensated this way because you don't have any cash. And it's one of the best ways to ensure that everyone's aligned with the company's success. It's really important, and it's a great tool that really helps a lot of companies get off the ground. So that's kind of the founder's equity. Now, once those shares are sorted, I think the next step is thinking about setting up the cap table and kind of building up the structure for all the other parties involved: early employees, investors, advisors. I think, a generic cap table, let's say, like it's just to start off with some benchmarks to put some numbers on the table, is founders usually get 60 to 70% initially. You've got another 10 or 20 reserved for investors, another 10 or 20 set aside for the employee equity pool, and then maybe another 2% for advisors or board members. Mark, is there anything that any advice at this point that you have in structuring cap tables that, can help founders avoid red flags that might put off some investors?
Yeah, I can just put some color around those bones here. So first, in the founders, there's really 2 types of companies to be built, and you get in trouble when you try to straddle the 2 strategies. I think this insight that I'm going to drop, I think, is one of like the few things that I've contributed to kind of the greater thought piece of the venture game. Everyone, if you've been listening to this, I wrote a really boring book a dozen years ago. Page 30 or something, that first chapter or so is the magic to read. couple of business schools have picked up this framework and are teaching it now as they're part of the core curriculum. But there's really work that needs to be done by founders to figure out whether or not they're building a venture scale business early. Because there's two completely different strategies. If you're building the next unicorn, venture-backed unicorn, the game you're in is you're trying to bring an entire village, maybe a city, together, and you're going to own a small piece of a huge pie. And so divvying everything up as a founder all makes sense. If you're building a company that is not going to be huge in that framework, there's a 2x2 in there that'll put you to sleep, but is useful. The goal is to own a lot of a small pie, and you don't want to divvy up. So yeah, I agree with the ownership kind of thing in the founders, but the double click is within that founder segment. Depending on the type of business, you may not want to have other co-founders, right? Depending on the type of business, you may be thinking differently about how much capital you take in. So it's very important before you kind of go into this cap table construction with the framing of what type of business you're building. I think I'd throw out is the employee equity pool. Having an option pool is a really sophisticated, nice thing to do, and it signals to investors that you get, if you're going to take in outside capital, how the game works. But it is not required, and it technically doesn't matter. Here's why. You set aside 10, 20% of the cap table for options, and those are, essentially phantom stock that you could grant to someone who isn't on the team yet to compensate them for joining. That's not, it's healthy to do, and there's legal paperwork, and it's a really good signal to do, but it's important for entrepreneurs to know that it's phantom. You can at the board level wave a magic wand and make it all evaporate tomorrow, and you can always make more tomorrow. What you're doing, though, by earmarking some phantom shares, this option pool, is you're saying, hey, we know we're going to have to allocate to hire people. We're comfortable with dilution. And what you're actually doing is pre-diluting yourself before investors get in. So there's some game theory a little bit around who's going to eat the dilution of employees. If you put it in the option pool, it's all in the founders. If you build an option pool after your next investment, well, the investors also get diluted by it. So there's a little bit of gaming around that. If you don't do an option pool, you still can hire people. You just grant them shares when you need to. But it is good hygiene. It is good optics. So the key concept here is investors like it, and you should be thinking about who's going to eat the dilution of the employees. In terms of the investor percentage, sorry, I'm going on a little bit, but I think it's interesting.
Go for it.
The investor percentage here, the rule of thumb in venture is investors buy 20% of the company every round. So when you're thinking about how much they're going to own early on, how to think about that, maybe it's different if you're raising a smaller than average amount, but that's a good rule of thumb to kind of use.
Got it. And then on the topic of the equity share for the equity pool, I quoted 10 to 20%, which is like a pretty large range. In thinking about how to really target that number, if you decide to set one aside, I think there are a couple of things to think about when you try to figure out that number. I think the first is thinking about how many people you'll need to hire before you get to your next major milestone, right? Because that's who the people that are going to share that pool. So a lot of startups start off with like 10 or 15% in the pool, and that might get bumped up to a little bit higher in later rounds. I think it also depends on what kind of company you have. So consumer companies need bigger teams initially because they need people to handle marketing, customer support, design, so that they can get to this fast-paced growth. So I think for those companies, a larger pool of 15 to 20% might make sense. For B2B companies, you have a smaller team at the beginning, right? It's usually an engineer, maybe a sales rep or two, or maybe even not because the co-founders are handling the sales. And so maybe a smaller pool around 10 to 15 makes sense. So just a couple of things to think about if you're going to do an equity pool.
I want to say on this, it's dead on. And culturally, the market expects 10 to 20% as a pool. If you do 5, it looks weird. If you do 50, it looks weird.
Right.
You sharpen your pencil within there to make an argument for you land. It doesn't matter as long as you're in that zone. The thing to think about, though, when you're sharpening that pencil is equity grants decline logarithmically by round. Founders get double-digit percentages. Early employees get maybe a point or single decimal, right? Like half point to a point.
Yep.
After the A, everyone's getting 0.1 on the upper end, and it goes down. So every time there's a round, you move the decimal point for how much you grant to people. It's not exactly that. There's some areas where this breaks, like you bring in a CEO a little bit late, they might break through a threshold. But when you're budgeting, you can basically say, okay, all the hires, they're literally 10x cheaper after each round of funding because the risk is so much less and the salary and cash comp is so much higher.
Yeah, I think that's right. Let me double click on that too, because when you're talking about those really early employees, which is where a lot of the companies that we work with in the incubator are, say your first 10 to 20 hires, I think really understanding what those people deserve or what are some good benchmarks for key leadership roles like VP of product or VP of marketing. I think you're right, like half a percentage point to 2% in that very first in those very first days makes a lot of sense. It varies really based on the level of responsibility and impact that they'll have. If someone's a rock star and a critical hire, you might go towards the higher end, like 1% to 2%. And then other roles that aren't as senior but still essential may get 0.2 to 1%. I would think about it based on the impact of those roles. So, consumer companies might grant higher percentages to growth roles like marketing and design. B2B companies might prioritize engineering or sales leads. So that's just a kind of a framework to think about it. And then next topic, I think this kind of brings us to what you were talking about before, is vesting schedules. So would love to understand kind of how you think about, vesting schedules. I know there's a traditional common structure that a lot of companies use, but there are a lot of tools that, depending on the way that your company is structured, to keep people motivated. How do you think about that?
So first rule of thumb is everyone's got a vest. We talked about that before. That includes founders. The second rule of thumb is there is a normal vesting construct for startups. It's a 4-year vest with a 1-year cliff. What that means is for the first 12 months, people have not vested any of their stock. After 12 months, they get 1/4 of their stock on that day. That's the cliff. And then after that, there's a monthly straight line, meaning they get 1/48 of the remaining stock every month that they're there. Here's the problem. That common cultural construct of this 4-year vesting with a 1-year cliff, which is completely standardized, and if you're getting a job anywhere, that's what you expect to see, was created in the 90s when it took an average of 4 years to take a company public from the date of starting. So idea conceived, inception moment, 4 years later, IPO. So with a 4-year vest and a 1-year cliff, you were kind of getting the team to go all the way to the finish line. But the good old days are gone. Companies are taking a decade plus to hit their IPO. It's due to regulatory changes, a bunch of other shifts in the market that have happened that have really elongated that cycle. And the vesting construct has not adapted. So I think as a founder, you need to, one, be aware that the market norm is the 4-year vest or the 1-year cliff and price accordingly, because you're going to be competing with other companies for talent. And so you need to know that that's the market. But there is a way I think about, really partnering with people who have major ownership positions and realigning vesting with what it takes to build a company or what it takes to get to the next operational milestone where they've kind of done what they were getting comp to do. So it might be a 6-year vest or a 10-year vest in some cases. And maybe you don't even expect people to be there for the whole vesting period. But the total amount you've given them, if they leave in year 5, well, they were compensated fairly. So I would say for the people who are getting double-digit percentages in particular, so 10% or more of a company, it's worthwhile to really be thoughtful about what that vesting cycle should be. And you don't have to fall into that market norm, because usually when you're giving double-digit percentages, you're only dealing with a few people, and you're around the table and you can kind of all look at each other and say, what's fair? What's the vision? What do we want with the company? So I'll leave it there. But the cultural norm is the 4-year vest, 1-year cliff.
Right.
Most people don't know that the reason why it was created is long gone. So it doesn't have the same basis now.
Yeah, I think that's right. And I think too, another thing to think about while you're thinking about how this vesting schedule works is, again, what kind of company do you have, right? I think there are kind of some big groups that, for B2B companies, they have longer growth runway. So those guys may fall into a longer vesting schedule. So you might want to stretch that vesting period slightly, in addition to individuals who may have different motivations. And you brought up a point that I thought was really interesting, in that, when you're starting a company, you don't really, there's a lot you don't know, right? I mean, I guess you have to put a stake in the ground, whether or not you're going to go after, a VC money, but you don't know how many rounds you're going to raise, what it's going to take. You have a general idea, or you have some hopes of what it's going to take, but you don't know. And I think that, dilution can be a big concern. If you don't know how many rounds you're going to raise and what your equity share is going to look like at the end of the day, as well as your employees. And so how do you know, how are you going to keep them motivated if, in 3 years, they're going to own a fraction of what they originally owned? How do you think about that? Managing dilution.
Yeah. Well, I mean, in theory, dilution happens when you issue more shares to the company. You issue more shares to the company, usually to bring in capital, so to investors, or to bring in more talent to team or advisors or whatever, but mainly team. And when you're doing that, logically, you have to believe that you're issuing those shares because you're making the company more valuable. So you went from 100 shares to 200 shares. So everyone owns half as much as they did before, to be extreme in this little scenario. But you're quadrupling the value of the company. So the absolute value of people's shares, while they might own a smaller percentage, it's worth more money. So I think management and the board is always trying to make those incrementally positive trades. They're taking in more capital. They're bringing on more team and issuing shares and diluting everybody, with the belief that they're making everyone wealthier. That's the economic reality. So dilution, usually when things are going well and when it's well managed, is a byproduct of value creation. And so it's an okay thing. Now, doesn't always work out.
Do you recommend replenishing your employee pool or individual employee grants when you're raising each round of capital?
I think the boards figure that out, situation dependent. But what ends up happening is most employees particularly get fully vested as they get re-upped on grants. So there's always this cadence for new founders out there. Boards will, as part of most board meetings, they'll be looking at option grants and the option pool and approving allocation to folks. So that's kind of systematic. Once you get the engine going and you get investors in, that'll kind of happen to you a little bit as the governance structures get put in place. So that'll resolve itself. And if you're in the early days alone right now and you're listening to this, you don't need to know all of that at this moment. And if you pick the right partners as investors and otherwise, it'll be sophisticated in the way it's managed.
Yeah, I think that's right. So I think you made some really great points. What I'd really kind of end with is, just to recap, that founders should really start with a clear structure. It doesn't have to be a 100% accurate or predictive of what's going to happen in the future, but just be thoughtful about your cap table. Set up a realistic employee pool early on if you choose to. And I think the last thing to really think about is, managing equity. It's not just about the numbers. mean, it's a lot of it is the numbers, but it's just about keeping yourself and your team motivated and to make sure that everyone's aligned with your long-term vision for your company.
It's perfect. This is a great session. And the cultural norm of what's being constructed is designed to be adaptable to all of the unexpected scenarios in the future. That's why people like this cultural norm, is it tends to adapt well if you need to hire more people or raise more money than expected or make changes. It's kind of a flexible structure. That may not be obvious from the outside, but the way the mechanics of it work is that allows the business to kind of bob and weave in response to market forces.
Yeah, great point.
Thank you, Phuong. All right, that was a big one. I think that's going to be one of the episodes that, as I said in the beginning, people are going to be listening to for years to come. Hopefully it's helpful to folks. If you have questions or things you want to kind of double click on, which is a cheesy phrase we said way too many times in that podcast, drop the comment on the, wherever you're listening to this. We'll give you a right back. Drop us an email, whatever. But happy to help people fill this in. Also, if you're trying to navigate if you're at this stage, this is a good moment to pick up my book. It's on Amazon. It's called The Fundraising Rules. It's extremely boring, but it is very functional for figuring out how to set up and structure a company. It kind of runs through all this stuff in depth. So with that, we'll catch you next time.